When central bank prints money, people are making millions out of the stock market. But that brings an important question. How do we know if a stock price is high? Does stock valuation still work when excessive money is being printed? Traditionally, stock is valued based on expected cash flow of the company, namely growth and discount rate, which is affected by interest rate. As a retail investor, we probably don't need to know too much technical details. As a general rule of thumb, stock rises when a company's business is growing and credit environment is accommodating. For example, when central bank lowers interest rate or prints money. Or a more long-term view is the consistently trending lower interest rate like in the past 40 years. But there is another factor that's usually overlooked when people look at stock prices. I call it the hype factor. Hype is completely driven by speculation and is particularly relevant today. Sometimes people can get very enthusiastic about a certain direction of the economy. When more and more people join the stock market rally, stock prices will get pushed to risky territories. Most of the time, people are extremely accurate about the imagined future. The problem is, that's not an adequate justification to the stock price. Stock will get dragged along to very vulnerable prices when hype is building up. For example, prior to the dot-com bubble, internet hypes were everywhere. Some companies' stock price were beyond ridiculous when the company didn't make a dime yet. People were extremely enthusiastic about the internet future, which they were correct, but stock market eventually collapsed in 2000. Even though you could be right about the future, remember, that's not an adequate justification to the stock price. So can the rising stock price be justified? Hype is all over the place, such as Bitcoin these days. These assets are very vulnerable to changing conditions, especially credit environment we mentioned earlier. When liquidity is abundant, hype can be maintained. That's why you see even though people are worried about the company's stock price, the stock just keeps going up or fluctuates around where it is, but somehow you know something doesn't feel right. In the stock market, changing direction usually happens when money is tightened. This could be a rise in interest rate or Fed selling treasury bond back to the market. When that happens, the stocks that were inflated by hype will get hurt badly. So stock is priced based on cash flow, credit conditions, and hype. How do we know to what percentage a stock price is built on cash flow, on interest rate, and most importantly, how much is built on hype? First of all, I'm going to briefly talk about the traditional way of stock valuation, its merits and shortcomings. Then we'll try to solve the hype mystery. One of the most popular methods for stock valuation is the stock multiple. Stock multiple is calculated by dividing the stock price by some company's fundamental value. By looking at a stock multiple, we're able to decide how much we're paying for a company's underlying business. For example, the price-to-earning ratio is calculated by dividing the company's stock price with its earning for the past year. We call this the trailing PE because it's already happened. One of the shortcomings of a trailing PE is that it's backward-looking, and some believe the market is forward-looking. If a company is going to release a new product, enter a new market, or improve its operation efficiency, stock is likely to trade higher. Trailing PE won't take these into consideration, so many people prefer to use forward PE. Forward PE is to divide the stock price by how much the company is expected to make next year. The problem with it is that it relies on forecast. Now say forward PE is 15 times. What does that mean? Not a whole lot. PE is a relative measure. To find out if a stock price is attractive or not, we need to compare it with the stock's historical PE. For example, if a stock's 10-year average PE is 14 times, now it's trading at 12 times PE. Looks like a good buy, right? Well, not quite. Blindly choosing stocks that have lower valuation may lead you to a portfolio of low-quality holdings. The company's low PE may be justified by the deterioration of the company's fundamentals, and a higher multiple may be justified that the company is growing at a faster rate. Stock multiple provides a handy way for us to gauge the stock's pricing, but it can't really tell us whether a stock is overvalued or undervalued. In order to choose stocks that are good buys, you need to have a thorough understanding of the company's business and its future prospects. Then use stock multiples to decide whether the stock is overvalued or undervalued. If a company is growing very fast, such as Tesla, how do we know the stock price is high or low? PEG, or price to earning to growth ratio, measures how much the stock is priced relative to the company's expected growth rate. It's calculated by dividing a stock's price to earnings ratio by expected earnings growth rate. By calculating the PEG, we're able to exclude a company's growth factor out of its valuation. By comparing a company's PEG to the company in the same sector with similar growth rate, by and large, we're able to see how much hype is built into the stock price. For example, Amazon is expected to grow at 38% for the next 5 years. Its price to earning ratio is currently at 61, which gives us a PEG of 1.6. In comparison, another stock in the technology sector is Tesla. Its PE is 603, which is off the chart by traditional measures. Tesla is growing at 45% for the next 5 years, which gives it a PEG of 13.57. With both very high growth into the future, Tesla is trading at a price that's close to 10 times more than Amazon. Again, one ratio provides some but limited insight into a company's fundamentals. You should never rely on one indicator to decide whether to buy or sell the stock. In order to choose stocks that are good buys, you need to have a thorough understanding of the company's business and its future prospects. To get reasonable confidence, buying individual stock requires research and probably a fair amount of financial knowledge. So a lot of investors today are choosing index fund or ETFs to gain exposure to the stock market. Which brings the question, how do we know the stock market as a whole is overvalued or undervalued? Named after Warren Buffett, who called the ratio the best single measure of where valuations stand at any given moment, the Buffett indicator is often used to value the entire stock market. To calculate it, we divide the total market cap of the stock market by the total income of a country, or GDP. Theoretically, this indicator should increase slowly over time due to technology allows labor and capital to be used more efficiently. The Buffett indicator started rising after Ronald Reagan took office and started the supply-side economics. That's when we entered into decades of falling interest rate. The Buffett indicator successfully foretell the internet bubble in the 2000s, when it's 67% above its historical average. Now it's sitting at 82%, suggesting that the stock market is significantly overvalued. Using Buffett indicator to justify the overvaluation of the stock market has shortcomings, particularly when we have a lot of free money flowing around. The most important shortcoming of the Buffett indicator is that it doesn't consider non-equity asset markets. In reality, investors have many different asset classes to choose from when considering portfolio distribution. For example, treasury bonds, corporate bonds, real estate, and commodities. Remember, stock is priced based on not only growth, but interest rate and hype factor as well. Buffett indicator doesn't take into account the impact of interest rate. For example, during the internet bubble, 10-year treasury yield was at 6.5%. Today, the rate is around 1.6%, significantly lower than the dot-com bubble period. The interest rate model takes into consideration the effect of interest rate by looking at the relative valuation of the stock market given current interest rate. It values the stock market by comparing the S&P 500 adjusted for inflation with the current interest rate. When the stock market is overvalued, this indicator will be above its historical trend line. When stock market is undervalued, it's below its historical average. For example, in 2000, this indicator is 2 standard deviations above its historical average, meaning stock market is significantly overvalued relative to market interest rate. It currently sits within 1 standard deviation above historical average. This suggests that the stock market, though high in price, but relatively fair valued when taking interest rate into consideration. You can find these valuations from currentmarketvaluation.com, which I will leave a link in the description. Here, I like to emphasize that there's no single measure that is either comprehensive or consistent over time. In order to minimize your chances of being wrong, you need to have a thorough understanding of the economy and policy's effect on the economy and the market, particularly now when the pandemic, monetary policy, and fiscal policy cause a lot of distortions in the market and the economy. Perhaps many of you don't know that 1/3 of the America's disposable income in April is from the government. You've seen the insane amount of speculation like the GameStop casino or the $60,000 Bitcoin before its fall. If we move beyond the market, distortions happen in the real economy. The median home price is up 17% from last year. In some areas, the increase is much higher. Perhaps the biggest distortion the pandemic caused is inflation. Inflation is such a hot topic right now. I put out many videos explaining the basics of inflation, the relationship between printing money and inflation, the history of how monetary policy and fiscal policy affect inflation, as well as how to invest in inflationary environment. They're included in the inflation playlist. You can check them out if you're interested. Well, thank you guys for watching the video. Hope you get something out of it. Please don't forget to hit the like button to help me with the YouTube algorithm. Last but not least, best wishes to you, my friend. I'll see you soon.